So today I just want to talk a little bit about potential stock market surprises for 2017. A lot of people are very optimistic coming into this year, partially because of some uptick we've seen in economic data. Of course, we have a new president that's about to take office, and so there's a lot of optimism out there that I'm gauging, and I think that's all very good, and I feel that as well. So one of my potential stock market surprises for 2017 actually is that it could be much more volatile than what a lot of people think it might be. And part of the reason for that is that if you look at the history, the post-election year actually tends to be pretty bad for stocks, or at least quite volatile. That's number one. And number two, the 7th or 8th year in the decennial cycle, which is sort of the, your decade, tends to be not very good for stocks, or again quite volatile. So I think surprise number one for the stock market in 2017 could be that this potentially excessive optimism coming into the year might lead to quite a bit of volatility, and probably quite a bit more so than people think. To sort of back up or verify this potential 2017 stock market surprise, I'm going to show you guys quickly a chart of the S&P 500 that I think does a pretty good job in explaining what I'm looking at from a technical perspective and how this potentially matches up with this potentially negative or volatile surprise in 2017 for the stock market. So here's this chart that I just referenced to. I'm going to keep it very simple, and again, this is mostly for perspective for, again, what could be a potential surprise here in 2017 of a bit more volatility than people seem to potentially think could happen. Number one, keep in mind where we are in terms of the big picture. We had a big picture consolidation or bear market that took place in the year 2000, right into those 2009 lows. And then, of course, that gave rise to a new cyclical bull market and also a new secular bull market, which is when it started breaking out of this basically a decade and a half of sort of sideways trotting. So actually not a decade and a half, about 13 years or so of sideways trotting, more or less. Anyway, long story short, we are now able to apply what I would consider a very basic sort of wave counting thing. And to be in full disclosure, I'm not a big wave counter. I think this kind of LA wave stuff, it's subjective, and I'm not a huge fan of it. But just for reference points, and again to kind of give my 2017 volatility surprise for the stock market case a bit more credibility. Basically, we have wave 1, wave 2, wave 3, which is the biggest one, wave 4, and now we're essentially in wave 5. And if anyone is familiar with wave counting, basically wave 5 tends to be the last major wave. So the last major wave also tends to see quite a bit more volatility. So again, from a wave counting perspective, from a cyclical and a secular bull market perspective, considering where we are in the cycle of a new president, all those kind of things together, to me, it really could be that we see quite a bit more volatility in the broader market. And I do think it's going to be a wonderful year for trading opportunities, but maybe not so much for a buy and hold strategy.